radio for a really great future. We're talking real money.
Okay, here's the deal. You're nearing retirement. You're looking at your money and you're going, I don't know if I'm going to be able to have the kind of retirement I really, really want. So what can you do? Well, that's what we're going to talk about. Some quick and easy, down and dirty, get right down to it ideas to help you, quote, close the retirement gap. I'm Don McDonald, talking real money along with Thomas Charles Koch, the World War II model military aircraft enthusiast. And
my daughter did a Zoom call with we have a family connection, and so she got to do a Zoom call with the president of a college, and she did it in my office with all the planes. So she had to explain.
Did she do it with all the planes?
And she said, I tried to tell them, why they were there and stuff. Guys, like, what the heck? What's that all about? So anyway,
yeah, she should have said,
well.
I am passionate about aviation history, and together
What's
with
that
my
one
father,
right ahead of you?
We've spent many an enjoyable Sunday afternoon building model military.
We should have one of those little plugs in her ear when she gets.
Yeah, I could be your producer.
Exactly. No,
Okay,
ask them about this. That would have been good. So didn't happen. Anyway,
so welcome to our little get together. We call it a podcast.
Yeah.
Why do we call it a podcast? Because Apple said, let's call these things where people talk on our iPods podcasts.
Yeah,
and
really smart of
them. For some reason, it stuck.
Yeah. Since most of the listening, is Apple still the number one more than Spotify, et cetera? Okay.
But they're really, really close. Apple and Spotify are definitely the top two.
But I read the interesting email from Clark Howard recently about how still was it 6 out of 10 of their listeners come through Apple? They still get very few through Spotify and other places. I think I forwarded it to you.
We get about 6 out. We get about 6 out of 10 from Apple. But here's what's really interesting is for my short story podcast, like lit reading and the like. With lit reading, not lip reading.
I wasn't going there. Okay.
You were gonna do it. I know you were.
It was in my head, but it
was in your head. I could feel it. I could feel it like emanating from
trying to be a better person.
Wee little lizard brain. Anyway, no, it's the other way around.
Because it's younger audience at Spotify, right? Is that the deal?
It's a younger audience at Spotify than at Apple.
Okay.
So it skews a little younger because it's more of a music. It was originally a music venue that added podcasts, whereas
That's right.
Apple Podcasts has been Apple Podcasts Apple Podcasts.
Yeah, right.
It's always been podcasts.
Yeah. That'll change over time, I think, right?
I am trying really hard, too, by the way, to get Apple Podcasts. I have started a whole bunch of short story podcasts. This is my hobby. I started New Tales Told, which is original short stories that I wrote.
Yeah,
I write those. Then what I did is I took all of my, because I noticed they were really popular, all of my Christmas and holiday stories, my Thanksgiving, I've got like 2 Thanksgiving stories and a New Year's story and all these Christmas stories, and I put them on a new podcast called Seasons Readings.
Oh, how creative.
Readings.
Look at you.
Yeah.
I can make fun of that one, too, if you want.
To get Apple to feature my podcasts, because I'm just a small independent publisher of podcasts.
Not happening.
And now you've got all these major companies. I mean, you've got Apple putting out its own podcast. You've got
of course they are.
iHeart. You've got Wondery. You've got Spotify. All these big companies are cranking out, and they've got these big stars. And I'm like, I'm just a little Don McDonald.
Yeah, and along those lines, it's still, to me, a miracle that we continue to be around the 75th most popular investing podcast.
Between 50 and 75.
I know. And again, we're up against the Jim Cramers of the world, the Jill Schlesingers. It's crazy. So,
and we, by the way, we are in the top 1/10 of 1% of all podcasts in the world, and there are 4.5 million of them.
That's in terms of downloads?
Downloads.
Wow.
Yeah.
1/10 of 1%.
Of 1%.
Wow. I think we should call it today. That's it. We're never going to get any higher than that, right?
I know, but then
why go on?
What would we do? I'd just read short stories all day then. And I'd be all alone.
Okay. All right.
I wouldn't have you on my little screen from 3,000 miles away.
I'd still call you every day.
All right, let's turn to our topic of the day.
Please.
Tom has gone out and painstakingly compiled a list of 3 simple.
Not really. Not really. No.
What? Where'd you get the
It's
list?
not very painstaking. I got to be honest with you. I did think about it, and I did ask a few members of the advisory staff for their input. But
Did you?
yeah, I did.
Well, that was
I always do.
work.
Okay.
That was more work than you usually do for the topics of the day. So
All right.
what he
What
wants
are
to
we
share with
talking
you is
about?
3 ways.
No,
that
let me explain the problem first. Then I'll take.
Oh, I thought I already explained the problem. Getting
You
into
didn't really
retirement
give any
without enough
numbers to
money.
it. This is work from Vanguard. It says only 40% of workers, 4 out of 10, between the ages of 61 and 65, the youngest members, by the way, of the boomer cohort, are financially on track for retirement.
That's all?
That's what it says. Now,
Oh, that's sad. Okay.
here's the thing about that number. You and I know this. So few people have actually run the number because so many people, it's like going to the doctor. Oh, my knee will be okay. I'll get to that next year. People say this all the
I wonder
time.
why you would bring up knee as an analogy, huh?
Because I'm
Could it
hoping
be
I get
your
a new one soon.
Flipping meniscus?
Yeah. Most people simply do not sit down and run the numbers, but they kind of look at it generally, it's not going to work. So, and by the way, today, this is a number you probably don't know. It says,
I don't know most numbers, so just go ahead.
it says that we're at peak 65. There are 11,000 people a day are going to turn 65 right now until the year 2027. 11,000 a day.
Happy birthday to all 11,000 of you today.
And welcome to Medicare.
And welcome to Medicare.
Yeah. So
Social
okay.
Security should come a little later. Just wait on that.
And please, this is a topic that comes up regularly. It's going to be close. What do I do? Right? It comes up, and we get it, right? Because all those other things. By the way, generally the people that come to the office that have multi-millions of dollars, guess what they did? They didn't have children. No offense. It's almost universal. Like, I have $6 million. How many kids you got? None. Really? Yeah. Okay. And I love my kids.
So that's what it cost me to raise those kids, was like $6 million?
Basically, probably. Anyway, so what do you do?
Why did I keep...
right?
Oh, I know why I kept doing that. Oh, I forgot the why.
Yeah, exactly.
Yeah. Okay.
Not hard to remember now.
It's so easy to get a guy to have kids.
Yeah, that wasn't a lot of convincing there. So, okay, a couple ideas, and
Yes.
one of them is one that we're using, and frankly, I was consciously and subconsciously
I got to
working
say,
longer.
wait, after this build-up, these 3 things better be extraordinary.
Or I'm out of here. Yeah. Working longer. Keep working. And it doesn't have to be full-time. We have clients who kind of retired and then said, I could still do 10 or 15 hours a week. And guess what? They're not pulling on their money because they're getting a little income from there. They're also taking Social Security. One of them just met with yesterday who's 71. And he's not pulling on his investments because he's getting enough between the part-time work and Social Security to pay the bills.
Wow.
And he's putting off the money. Now, in his case, we're like, dude, you got the money, go spend it. But delaying retirement is this is from a CNBC article, a silver bullet when it comes to eliminating or shrinking a retirement funding gap. I couldn't agree more. I think it's huge.
And I'm telling you, a lot of you are going to be bored in retirement at some point. I see it all the time with people. They go, okay, I did the vacations. I did the sitting and reading 33,000 books. I need to do something.
33,000 books. How many books do you read in a year? Somebody just asked
I
me.
read a lot. I read a lot now that I got Kindle Unlimited.
How come I don't have that?
You got to pay a little extra for it, but it's like nonstop downloads. You just download the next book.
I'm still working on 1929, and then there's a new book on the Edmund Fitzgerald. It's in line right after that. So,
oh gosh, now you're I'm gonna have that earworm now. The song, the Gordon Lightfoot song.
Well, because it's
I was at Epcot
right after it happened too.
I was at Epcot Monday night, sitting in the British Pavilion, which is right next to Canada, and
Yeah.
I of course I hear the Muzak version of the wreck of the Edmund Fitzgerald.
Yeah. Anyway, what you're trying to say is engagement, purpose, important in retirement.
And the money
Adding
that
to the
goes
money.
with it.
Yeah, right. That's fair. I think that's good. Okay, but here's number 2. And this is one I think most people do not think about, especially true here in the Northwest where I'm based. The tricky
Umbrellas,
topic.
taking an umbrella.
Seattle's not an umbrella place. There was a piece in I think it was New York Times recently about how few people in Seattle have umbrellas. It's like, okay,
Do you
rain.
all know
What do
it
you
rains
got?
there?
I know. What do you? I don't have one. I'm like, okay, whatever. Rain.
When I was there
care.
working with Merriman, I would bring an umbrella to work every dang day.
And nobody would care. Addressing the tricky topic of home equity. For many people, the bulk of the money they have is in their homes. And this is another reason that we tell people on a regular basis, yeah, it feels great to pay off that mortgage, but you can't get at that money in retirement, save for things like HELOC is one, right? Mm-hmm. You could also do the reverse mortgage is another one.
Here's an idea. Buy an Airstream, and I know somebody who could sell you one. Buy an Airstream.
It's not enough to the shameless promotion of your other podcast.
Park it in the driveway.
Merry Christmas. He'll even wrap it in a large red bow for the holiday. So there you go.
Rent the house.
Where is that thing anyway? It's in Virginia somewhere, right?
It's in Asheville. The location of my story, A Chance of Death on New Tales Told.
Asheville, of course it is.
Asheville, North Carolina.
Here's what they say. Tapping into the home equity would increase the share of young boomers financially prepared for retirement by 20% from 40% to 60%. There's that much home equity available to get it out.
Tapping it, though, becomes very tricky unless you're going to sell and downsize
well, that
or
was
sell,
on my
sell
list.
and rent.
I think most people should, not all. I downsized, as you know, right? I'm living in a smaller place.
We had an idea for downsizing. We were going to add on to our garage apartment, onto our ADU, and we would actually get permits for that. And we were going to add on to it.
Oh, that was too easy.
Build like 1,000 square feet, and then it's like 600 upstairs for a couple of bedrooms, and then rent out our gigantic house in front.
Debbie is never going to leave that house. You tried that. You tried to move to Virginia.
Well, I got a friend, a really great architect.
She woke up and said, wait, I'm in
over.
Virginia now? Come on. No, that's not happening. Great idea.
Never mind.
But I think the home equity thing should be closely examined. Here's another thing. Do it before you quit. Because
reverse
sometimes
mortgage?
it can be... I think it's worth looking at, but certainly HELOC, because there's money you could draw from it if you had to. Now you got to pay that back. That's different than reverse. But if it was going to be close, I would at least look into probably both. Figure out how much it's going to cost. Because I forget what the upfront charges for reverse are now. It's not cheap.
They're not
It's not
cheap.
as bad as it was.
No, they're not as bad as they were. But in fact, while you do number 3, I'll look that up.
Yeah, I'm just saying, if it's going to be close and you're worried and you have substantial equity in your home, I would look into it, right? Here's number 3. This is going to surprise you because when I asked you for your 3, this was your number 1. Spend less.
Yeah, it's the easiest of them. It really is.
Both before and during retirement. Saving more money towards the tail end of one's working years can help accomplish that goal by forcing households to live on reduced cash flow. Oh, what a great idea. Typical retiree experiences a 20% decline in their consumption when they enter retirement, perhaps because of lack of savings causes a reduction in their spending. I have, by the way, seen it go the other way most of the time. Most people end up spending about the same, at least because they have time. And guess what? When you got time to spend money, sometimes you do spend money. But that's a no-brainer and should be looked at carefully prior to
it absolutely should. Now, I got the numbers here on reverse mortgages these days under the FHA programs, which the FHA is now regulating these more tightly.
It is. They do, yeah.
There is right off the top, there is 2% of the home's appraised value that'll be deducted from the proceeds and go into your mortgage insurance pool.
So let's say your home is $1 million. There goes $20,000, right?
Right,
Boom.
right off the top into that to pay.
And
that's
there's
to pay
only
for the
a
insurance.
percentage you can take. It's up to like 40% of the equity that you can actually haul out. I believe there's a limit.
I can
and it's
find
gotten
that
tighter.
number. I don't have that here right now.
It's gotten tighter the last few years.
And then the origination fee can be up to
how much?
$6,000.
Okay, again, but that wouldn't kill. So, but now all of a sudden, on your $1 million home, you're talking about almost 100 gone out the window, right? 60 plus 20.
No, 6,000, not 60,000.
Oh, 6,000, not 6. Okay,
6,000.
pardon me.
6,000.
Okay,
6,000.
6,000. Okay, that, again.
And then your other fees run between 2,000 and 4,000. So you've got upfront costs of
there's 10 and plus the
3 or 4%.
20. Yeah, okay. Yeah.
And then the typical reverse mortgages, you can get a variable rate or a fixed rate, and the rates run 6 to 7 for fixed, a little lower for variable, plus another 1/2% per year in insurance premiums.
1/2% of the value of the home.
Of
or
the
one
loan
of
balance.
The loan balance.
The loan
okay.
balance.
So now we're looking at, in today's world, on a 30 fixed, you're probably looking at a 7. Remember, you're not paying that back. That's just
7.
money. That's
Yeah,
so
it just
what that's doing.
accrues.
It's eating away at whatever equity's there. So you're using money today that won't be there later if you had to have it. Because oftentimes I look at people's plans, I say, well, the Alamo is going to be your home equity, right? If everything blows up, you sell the place and you've got the money there. If you've done a reverse, that's going away.
And the way the amount of equity you can take out works, it's dependent upon your age.
Oh.
So the older you are, the more of your equity you can take. If you're really, really old, like over 80, and you just have to get some money, you can take out
how much?
Like 2/3 almost.
Wow. And how about if you're really old like we are? How much then?
Oh, at our approximate age, about 50%.
Okay. Oh, there you go. Because my wife the other day, I showed her what the balance of our home was when we were going through everything. She's like, we still owe that much? I said, yeah, we're always going to owe something on this house. I'm not paying it off.
Yeah, I'm not paying mine off at 2 5/8.
Yeah, well, you've got a much lower rate. I'm still praying for 30-year fixed at 5. So
you
may
keep
or may
praying,
not happen.
dude. You
I
just
know.
keep praying.
Okay, there's a couple other things we didn't mention that we mention a lot. One spouse, preferably the higher earner, should wait for Social Security until 70 because that's a big benefit. Another one that you brought up, and really in a nice job on a recent broadcast, was, and for this woman it made total sense, an immediate annuity sometimes can help because the money goes in, you get a set amount out, it gives you a budgeting tool, you're making a little bit on the money, and it's taken care of.
And let me just reinforce that. I want. This is for all those who think we hate all annuities.
Yeah.
No, it sounds like it because we hate the way they're sold in most cases. Really, it's about the way they're sold, and it's about the lies that are told. An immediate annuity can be a powerful tool for somebody who has to have a certain income for the rest of their life. It just has to be purchased carefully.
Yeah. And again, you looked up one when we were live on the air that was paying a pretty good amount. I was surprised at how much.
Well, it was about 7% of the amount put in.
Yeah, exactly.
But remember,
so
some of that's your
money
principal
back.
coming back.
Sure. Yeah. But for many people, the reason I like it is this is what you get every month. Oftentimes you show people you got 200,000, they say, great, I'm going to go get 50 to do whatever. You can't do that in this case.
Remember,
I love that.
unless you take a smaller payment, in essence, pay more, it's not going to adjust for inflation.
No, that's the amount is the amount. So in 20 years, that's going to be paying it's going to buy about half as much bread as it does today.
Yeah, you should probably freeze a lot of bread while the money's worth more.
I knew you have some comment. I hadn't even thought. Hey, wait, can you do that with gas? Can you do that with electricity? Can I freeze that up too?
Well, you have so many outbuildings, you could probably put some big tanks in too. Just don't pull a permit. Don't tell them.
Like everything else out there. We just decided to build this. You get a permit? No, we're out in the middle of nowhere. They'll never find us.
What? There's zoning?
Exactly.
All
right.
Zoning rules out here?
Let's see if we can straighten up here and answer a few questions. From Albuquerque, New Mexico, Robert writes, thanks for what you guys do. You've made me a way better investor. Thank you for that. Please excuse me if you've already answered this question. By the way, Robert, many questions we answer more than once, so it's okay.
Oh, yeah. I mean, really, I think we've answered all the questions.
We said that once on the show.
All of them.
No one's calling because we've already answered all of them. I'm looking at AVGE, which is the Avantis Global Equity Fund, and DFAW, which is Dimensional's All Equity Global Fund, and their portfolio composition. It says what percentages of the underlying ETFs are in them. I'm wondering if there's a way to determine what individual stocks they own as a percentage of their portfolio. If you click on the underlying ETF, it shows the individual stocks and their respective percentage of the portfolio, but I'm trying to see the respective portfolio percentage of AVGE and DFAW. Robert, need to find a new occupation. Because these are global rules-based funds.
For example, on the DFAW, you can look at the U.S. core equity and go, okay, its portfolio is made up of NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta.
Shocking.
Yeah.
But in a smaller percentage than you would get in the Vanguard Total World Index.
Because only 50% of the total portfolio is in this core equity, which is going to be the only fund in the DFAW that is heavily weighted toward the Magnificent Seven.
Yeah. You cannot find Don McDonald's 50-50 portfolio. It doesn't exist. You have to do that yourself. If you want to have 50 U.S., 50 international, there's a one fund.
You got to make your own. No, there's not a
own.
one fund. Mm-mm.
Anyway, I, by the way, just for the record, either of those funds would be a very fine place to invest for.
The more aggressive, the smaller, more value-ier of the two is AVGE.
Yeah. How many stocks does it? It's hard to tell because you got to.
I can't tell because it's the funds.
Pull them apart. Yeah. Right.
Yeah, and I could pull them
just
apart,
for the
but
record,
I'll give you my estimate of how many stocks. It's about 11,000.
No, I think it's less because they're pretty restrictive. If you look at AVUV, et cetera, et cetera. So
really,
well, okay, yeah. Anyway, that's fine.
Maybe.
But the
10,000.
thing is, you're still getting decent diversification. You're getting academic principles, and it's rules based, as you point out, Don. It's not just the Wild West. They're not picking and choosing. There's actual rules that go into all this. So, good question. Yeah, you got something else?
No, me? No, I'm just waiting for you to ask the next question.
Indigestion or something. Okay, Andy writes
I'm actually looking things up while you're speaking.
Andy writes us from Columbia, South Carolina. Hello, Tom. He didn't mention you.
Apparently not. Okay.
Spouse and I are 52. $800,000 in a Roth IRA. Don't anticipate ever using it and passing the Roth to our children. They have $2.5 million in taxable investment accounts, 100% equities. That's IRAs and 401k roughly of $3.6 million. So between those two, that sounds like, 6.1 million. That's a lot of money.
Yes.
Yeah, it's great. So, but the question is, took the risk assessment on your website. Score was 83, which is a very high score, by the way. Mm-hmm. Group is 5. Thoughts on the Roth IRA, because remember, there's money they're never going to spend. They're going to give it away, which is great. What a great gift.
Then you just be aggressive. Who cares?
Yeah, but he wants to know your opinion of the funds he holds. AVUV at 35%.
That's good. That's
which
aggressive.
Is U.S. small cap value. FNILX, which is U.S. large, at 30%. AVDS, which is Avantis' international small cap value. DFIV, no, I don't think there's any value in that one, but it's international small cap. DFIV, which is a Dimensional's international value at 8%. And AVEM, which is Avantis' emerging markets at 10%. So 35 in small, U.S. small value. 30% in U.S. large, basically. And
just
so that's
large across the board.
65%. Yeah, and then you got the 17 international small, 8% in international value, and 10% in AVEM. Hard to criticize that portfolio.
I'm fine with that whole
it's a little
doggone thing.
It's a little leaning pretty doggone small value. I mean, then you're going to expect some really wild rides from time to time with that much U.S. small cap value, but you should have a higher expected return.
Now, before we go on to the next question, I just want to rebut your comment on the diversification of
I was wrong about
all-world funds.
How many?
Well, given the fact that I'm just using DFAW, their emerging markets fund alone has over 6,000 stocks.
No, okay. I said AVGE had like 6,000 or 7,000.
I'm going to bet AVGE is.
There's no betting
similar.
On this show. First of all, we're not supposed to do that
because if DFAW has 12,000, I can't.
And
imagine.
if we're gonna do a bet, we'll do a prop bet on how many goals my daughter will score in the title game this week.
Oh, I already know the answer.
Yeah, exactly. So
I'm not.
she doesn't listen
I'm not
to this
that
program.
mean. I'm not as mean as you.
I know. I had to pull that. All right, we ready to move on, or you're going to take me to the shed here on how many?
Ready,
but
for you.
In a general sense, Avantis holds fewer stocks than Dimensional. They're more selective. They have a tighter net, if you will, or sieve.
Yeah,
to
you're right.
separate
You're
out
right.
stocks.
They only have 4,000 in their emerging. So
that's
altogether
2,000
they'll
less
have
there.
about 9,000. It looks like.
So it's few. I know it's fewer because I remember when we first looked at them, we thought this is more. Well, at the time we thought it was stock picking, but it really is rules based. All right, from Everett, Washington, James writes, "What is your favorite Washington 529 plan?"
I don't know any of them.
Well, I only know the one.
Which one?
The Washington 529.
Oh.
I didn't have time to look this up. But there is
hold
still a
on.
GET program of some kind, I believe, as well. Maybe that's what he's asking.
What's GET? I live in Florida.
Guaranteed education or guaranteed tuition thing or something. So people sometimes ask me about that. And if I'm wrong about them still
that's
offering
the
that,
one where
please.
you pay and you just get an education at a Washington
Exactly.
school.
Yeah, exactly. So,
which I would not like as well because your kids will invariably not want to stay near you.
the last has already said moving to California. Good luck.
Actually, there are two choices, Tom.
Okay.
I just
What are
looked it up.
I appreciate
There's the
that.
Washington 529 Invest
Yep.
Education Savings Plan and the GET program. That's it.
Yeah. I prefer the 529 due to flexibility.
Wait a minute. What would be why not go with Utah's 529? Because there's no tax advantage in Washington.
No, you get no break. No, I think if you're making a choice, then yeah, you would go with that. If you're going, I think the question here is, should I use a GET type of program where I pay in, get a certain number of credits, college is paid for, versus a 529? So it kind of depends on the kid.
Yeah, it really depends on the kid. You need to ask your kid, okay, here's the deal. I'm going to put money in this program.
You're going to have to stick with this, too,
You've
by the
got to stay in Washington. You can't leave.
Yeah.
And you can't go to can you go to a private school under GET?
No.
So you can't go to Tom's alma mater.
Which is a shame because it's a great school. So
Yeah, with 12 kids.
it's gotten much better since I left. Let's put it that
Probably.
way.
There was nowhere to go but up from you.
Yeah, exactly. We got time for one more?
Oh, I always have time.
Okay, because it's really brief. It's from Sam in Salt Lake City, Utah. He says, should I consider investing in quantum computing?
No. There you go. Thank you.
I was going to say yes, because if you invest in a globally diversified portfolio, you are investing in quantum.
Yeah,
computing.
okay. One
Very small number.
tiny little
not
1/100th
quantum.
of
Yeah, that's
1%, maybe.
You're not
but,
going and picking individual stocks. You're not buying it as a sector. So
Yeah, no, because wait a minute. Hold on a second.
okay.
We don't even know if quantum most of us don't even understand how the heck it works. Apparently there's a cat in there somewhere named Schrodinger or who's owned by Schrodinger or something the reason Schrodinger's cat is in there because if we don't look, the cat could be alive or dead. That's quantum computing.
That's it?
That's it.
Really?
There you go.
I
It's
got to
the
read the
dead
Wall Street
cat.
Journal a little more carefully. I'm just not staying up on things.
No,
That
what
was
it
the
basically
best
quantum
explanation
computing
I've
is
ever
so
heard.
confusing. It's saying that a particle,
Yeah.
a thing, can have infinite numbers of states. It's not just on or off. I guess it's the ultimate grayscale.
Okay, well, where are you on AI? Just investing in AI these days.
I'm against that too.
Okay.
I'm against
Apple
just
Pie,
investing in anything.
Chevrolet. Okay, just
No,
checking
I'm
how-
not happy
on
with
there.
General Motors. I will not ever buy a General Motors car now because they're not putting CarPlay in them. I haven't bought one. Have I ever purchased a General Motors car?
I don't think I ever have. I hate to say it.
Oh,
Now we're
wait.
gonna get the
Oh,
angry
wait.
letters.
No, let's see. No, that wasn't a Chevy. That was a Ford. Ford. No, I've never bought a Chevy
No, I don't think I ever have either.
ever in my life.
No, I'm not a very good consumer of American
But now they don't
products.
put CarPlay in them anymore, so not going to buy
Yeah.
one.
All right, that's it for the question. Keep them coming. I know the holidays are here, but please keep writing us, calling us, etc. Don't abandon us because the holidays are a lonely time. We need to hear from you. It can be very difficult for us, so please.
He's overly dramatic, and he's not the actor in the duo. All right, everybody. Thanks for listening. Thanks for being there. Go to talkingrealmoney.com. Send your questions in. If you want to meet with one of our advisors for free for nothing with no sales pitch, go to talkingrealmoney.com. Click Meet an Advisor. If you want to call us on a Saturday and just talk with us on our radio show, call us at 855-935-TALK between 3 and 5 Eastern Time. And in the interim, please take every opportunity you can when you get together with people over the holidays to tell them they should be listening to Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.